Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, January 24th. We're almost a month into the new year. I like this time of year. You start to see if you get continuation from last year's hot or warm sectors, industries, asset classes, or is there a shift? And how do we tell that? And what is relative strength? It's a term I use on here often. I've gotten a couple of questions on how we use relative strength. Relative strength is a comparison in performance or price action between securities or indices or asset classes. How we use it is to determine, very simply, what is outperforming and what is underperforming. Might sound simple and almost useless. Where we tend to make trading decisions from it is when we see securities, sectors, or industries rally, but their weekly relative strength score does not improve or marginally improves versus some other sectors or indexes. An example of that, I mentioned it last week. Energy. We booted energy. It had had a 10% rally year to date. The barrel of crude had rolled over, showing some negative price action. XLE had rallied up through a price that we were comfortable with. And even though it was up 10%, their relative strength had barely increased. That was an example of us looking at a name that was working or had worked that we no longer were interested in being part of the portfolio. We want to rotate that money into a security like Sky, SKYY. We also initiated that position. Cloud computing was showing improved relative strength. And today, with the markets off mildly, 30, 40 basis points, there was Sky up 0.5%. That's an example of relative strength. Why do I mention this? We're going through our international portfolio. Now, I know when you say international, everybody goes to sleep. So do we, by the way. But it's been a long time before you got any performance out of international equities. Quietly, you're seeing some performance currently. Into this strength, we're trying to identify which names are just up with demand, up with the market, versus which names are truly outperforming. We want to prune the names that are just up with the market. They're not doing anything on their own. They're just up because the broad indices are up. Let me give you a couple so you can keep an eye out on price action over the next 2, 4, 6 weeks. A couple of names we own up nicely in January, yet their relative strength score really not improving. France, Switzerland, 2 European countries, they're trading with Europe or a tick or two below. Those are names we have on the prune or eliminate list within our international portfolio. Where do we want to rotate that? We continue to see outstanding relative strength from Italy. And now I'm going to hit you with one that you're going to cringe when I say it, because I cringe when I say it. You know what's exhibiting much improved relative strength over the last 4-6 weeks? China. I know when I say China, you know, an X comes up in many of our thoughts and ideas of it being an investable place to put capital. And the only leverage we have into China currently is through an emerging market ETF, SPEM, SPEM. You'll see it in your global portfolios. Is SPEM, which you could say has enough leverage to China, is that enough to carry a China rally for us in the international portfolio? Or do we have to put some capital into names like MCHI, FXI, KWEB, all names exhibiting improved relative strength, even with these headlines about tariffs? Remember, headlines are headlines. Price action is reality. So I mention that because it's a name many people have discarded. You may see us talk about it from time to time over the next quarter. It may be a position internationally that we start to ramp up a bit. Time will tell. Let's go to the Moose, who filmed yesterday.
Thanks, Matt. I'm John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Thursday at lunch on January 23rd. This is the bond report. We're doing it a day early as I'll be out tomorrow, but it's a short week anyway as we had the inauguration and markets closed on Monday. This week, bond yields up a couple of basis points. You don't read anything into it. 463 on the 10-year bond, that's up 2 ticks. 428 on a 2-year bond, that's up a couple of ticks. Muni bonds, on the other hand, have had a good week. Yields are down 4 or 5 basis points across the board, so 308 on the 10-year AAA scale. And why? Because you really have had munis kind of just following along. Last week, they did not participate in the Treasury rally that we saw, so some of it is catch up from this week. I think it's important to look at, though, that we were at a 480 just back on around January 14th. So when we talk about the fact that we think that the fear of Trump was worse than Trump himself, we're sticking with that for now. Very little in economic statistics this week. One thing to take a look at, though, we had initial jobless claims come out today, a little higher than expected, and that has been all over the map. But generally speaking, over the last few weeks, few months, in general, they have been lower than expected, which has been one of the things that has pushed bond yields a little higher. However, we think it's important to look at something like continuing claims. We have a chart up, and continuing claims, where people are continuing their jobless claims, those are at the highest point, basically going back 3 years to 2022. We think it's important to take a look at that. We'll continue to take a look at that because there are some anecdotal signs of some more slowing down on the economy. Whether you look at the quits rates on jobs being much lower, they are. When we see some of the job postings that have been really fluffed up a little bit, they're actually lower than they're printing. That's another thing. We saw an anecdotal headline that caught our eyes this past week, where you saw graduates of Harvard Business School and other business schools as well, top-line business schools, Duke, MIT, some others. And there's the graduates of the top business schools, 9 months after graduation, with anywhere from 18 to 23% of their graduates still not getting jobs. That made us pause a little bit and wonder why. There's probably lots of reasons for that, but clearly corporations are reassessing their needs, and that tells you that story. Plus, you've seen a host of earnings reports come out of companies. Earnings okay, but they've also announced job cutbacks, and it's a litany of companies, and everything from drug companies to smokestack companies. So that's something we're taking a look at. Our belief is that bond yields should probably grind their way down from here over time. A lot of it's going to depend, of course, on the inflation numbers. We'll hope to see you next week, and we hope everybody has a great weekend. Thanks a lot.
Thanks, Moose. Great information. Thanks for watching. We'll see everybody next Friday.